You're basically telling me with the qualified small business exemption, 10 million of that 15 million could be tax-free.
Worst case scenario, 10 million tax-free. The 1202 in the tax code is the qualified small business stock tax exemption. It's something that I think a lot of entrepreneurs and investors really don't know about if they're starting out. I think a lot of people that maybe aren't in the tax space have never heard of this too. It's essentially a great tool that the government gives to you. I told you before that the government is usually pretty mean and wants to take your taxes from you, but they actually throw you a bone in this situation. And under certain circumstances, if you have a C-Corp that we just spoke about moments ago, you could potentially have a business that grows in value. And when you exit years later, you may have a significant gain from the exit that is actually not taxable to you. So this 1202 can be a fantastic tool to really save a lot on taxes, if not hundreds of thousands, maybe millions of dollars in taxes on your exit of the sale of the company stock many years down the line. So it is something that's very, very important and seldom used, generally speaking, but should be often considered in the tax space. And also when you're deciding to form a business, what type of business do I want? How is this going to work? That's what 1202 can do. It can save you a lot of money.
Okay, so there's this program, if someone qualifies for it, would save them a lot of money on taxes. How does a founder or an individual take advantage of this 1202 tax exemption?
Sure. So the basic threshold is the company has to be what's known as a U.S. C-Corp, and I sort of mentioned that before. You're starting this business. It's either going to be a corp upon formation of the company, or make the check the box election to tell the government we are a C-Corp. That's number one. Number two, you as the owner need to hold your interest in that business, the stock, for a period of at least 5 years. So this is really for someone who's going to build a business. It's going to take some time to get to the point where we're going to exit. So I need to hold it for that 5-year period. There's also some other parameters. For instance, the company itself has to be what's known as a small business. So what does that mean? The business itself can't exceed $50 million in valuation. For a lot of small businesses, this shouldn't be too tricky to get to, but that's another way to sort of lose this 1202 benefit if the company grows to the point where it's almost too successful, I suppose, down the line. And then, how did you take advantage of this? If you can meet all of these thresholds, if you exit later on, believe it or not, 100% of your gain up to 10 million or 10% of your initial investment, whichever is higher, can essentially be tax-free.
Okay. So
Michael, I have a question for you on that.
Yeah,
sure.
Will they allow you to write off if you have a 30 million gain? Can you get the 10 million benefit?
It depends. If you have 100% of the gain up to 10 million or 10% of the investment, whichever is higher. So I suppose to answer your question, Matt, from my typical experience, usually we don't necessarily see over the 10 million because we're dealing with small businesses, but it's whichever is higher. So potentially.
okay. So basically here, if I'm a founder and I get my founder stock, and then let's say I get 15 million when the company sells. Okay, that's my piece of the pie. You're basically telling me with the qualified small business exemption, 10 million of that 15 million could be tax-free.
That is, if 10 million is the lower than 10% of your investment, yes, that would be tax-free in that scenario. So worst case scenario, 10 million tax-free.
And oftentimes, if there's an exit, let's say there's a lot of times that the cash that's paid, or whatever the compensation that's paid, it comes all at one time, maybe with some earnouts and whatever else, but the majority of it comes at one time, which means a single tax year. If you get $10 million in a single tax year, what might your tax burden look like?
The answer is pretty high. I mean, right now, our highest tax rate, I believe at this moment, is 37%, although there's obviously fluctuations with the president's proposal. So if we're going to use that as a rough number, and it might escalate to 39%, do the rough math. I mean, if you're looking at that, you're looking at 3.7 million, if my math is right, on that gain. So the tax can be very, very substantial to the federal government if you do not qualify under the 1202.
Yeah. So when startup number 5, my fifth startup exited, I fell under this. I had this problem. Okay, it's a nice problem to have. There's no doubt about that. So I'm not complaining, but I had to do some special tax planning with my tax advisors to be able to deal with this. I'm based in California, so my blended tax rate was about 50%. So around 50% of the lump sum payment that we got was going to go straight to the IRS if I didn't actually plan for all this stuff. So it can be a huge amount of money. You work hard as a founder for your startup to grow. You don't want to see 30, 40, 50% of that being paid in taxes to the government. Okay, got to pay what you got to pay. You can't get around it, but there's no reason to pay more than you have to pay.